Intercompany transfer of assets, upstream transactions. We're going to see when we look at the upstream transactions that there are two major types, very similar to the downstream transactions. The first being the non-depreciable assets or land. And we'll account for those very similar to what we did with inventory, and downstream and upstream accounting is very similar as well. We'll also look at depreciable assets, and when we consolidate we must eliminate any gain, as well as adjust or add back any basis that needs to be considered. And then we'll also look at excess depreciation that may exist between the two parties. The GAAP requirements for upstream and downstream transfers are very similar. We must eliminate any transactions between the two parties, as well as eliminate any gain until the actual transaction occurs to a third party. The one big difference between upstream and downstream transactions is that an NCI is involved. So if there's any deferral, it must be allocated between the NCI and the parent. The first example we're going to look at is a non-depreciable asset or land. And we see the information here that's going to get us started with the parent acquiring the sub, the assets, the parent's income and the sub's income, and then the information regarding the sale of the land. The initial entry to record the investment is here. We'll compute the differential, and we can see with the NCI there, we get the fair value consideration, and we see there is no differential. If we break it down, there's no excess value to account for, but we do have book value of net assets, which we'll include in our book value schedule. And when we consolidate, particularly immediately after acquisition, we'll eliminate the equity. As we go through the other learning objectives, we're going to look at the upstream sale of depreciable and non-depreciable assets, and we'll look at the equity method of accounting and the consolidation accounting of each, and as it warrants, we'll combine the two if we can.